But what I want to understand is markets have been quite volatile. So how's everything been performing?
Well, it depends what you're in.
Well, how's your business been performing?
We've had an interesting time because quality, we pass the stock market up into bands of quality, the ASX 300.
Yep.
We only focus on the top quality companies,
Yep.
and we define quality quite specifically as a rate of return on incremental equity. And the high quality businesses have been the single worst performing. The highest quality decile has been the worst performing decile in the stock market.
Right.
So what's actually happened is instos who thought there was no growth in banks and no growth in resources were underweight those sectors. And so for the last 2 years, they've been buying the high growth, high quality end of the mid-cap market. And that's driven prices up a lot, obviously, and we've benefited from that. What's happened is perception towards growth in those sectors has changed and they were caught underweight. So recently we've seen the banks rally very strongly, we've seen resource companies rally very strongly, and where do the big institutional fund managers get their money from to buy those things to cover themselves because they were underweight? They sell mid-cap and high-quality businesses. So it's been a fantastic... You know, we've had for the last 12 months, we've been having 5-minute investment committee meetings. Normally they go for 2 hours. They were 5 minutes because there was nothing to buy, and now we can find quality cheap because of this rotation by the big instos.
Okay, that's interesting. Clearly on the 6th of November they had one view, and I don't mean the political view, they had a view of how the markets would interpret either person who have won. On the 9th of November, the market flipped on a dime.
Yeah.
US terminology.
Yeah, which just goes to show it doesn't. I mean, the fact that people are investing, and they're not actually investing, the fact that they're buying shares in anticipation of what might happen, I mean, it's pure speculation. It's like betting on black or red at the casino. You know, they really don't know what they're doing. They're just punting that there might be some historical precedent that'll be repeated this time with a Republican in power and
Reagan.
And exactly, and that'll be, you know, infrastructure spending, and that'll be inflationary, which is why bonds have come off. Although I do believe the move so far is just a reversal of the deflationary expectations. We haven't even got into inflation. And you might remember, I think it was 2 shows ago when I was on with you, I'd said that in my private account I'd shorted US Treasuries, and you were talking earlier, Charlie, about how extreme they were. At July this year, US 10 years were at 1.36%. which was lower than they'd ever been since Captain Cook first crossed the Antarctic Circle in the 1700s. And it was lower than where they were during the Great Depression. So, you know, Herb Stein, the famous economist, has a great quote, and I love using it. He said, if something can't go on forever, it must stop. And you just knew that that was not going to last forever. It couldn't. And so it reversed, with massive implications for asset prices right around the world. Every asset is priced off the bond.
Yep.
And over long-term interest rates, not short-term interest rates, and bond and interest rates act like gravity on the prices of assets and the value of assets. And so when interest rates go up, assets will go down. And that will be the big theme for the next few years. It won't be whether Trump's in or Clinton didn't get in.
Yep.
It'll be bond rates. That will be the story.
How sustainable? All these things we're talking about, and the flip from where you thought or what you thought of Trump to what you people are now perceiving of Trump, and the fact that the central banks of the world must be looking around going, what happened here? Like, we've been asking for government support, and now we get it in the form of a Trump presidency has created a complete change in attitude. You have said that the market is illogical, or it's not being...
Not in the short term, definitely.
Yeah.
Always.
So how sustainable are the higher rates when you look at the impact of the rest of the world as an anchor on it, the impact of currency, how sustainable are the higher rates?
I tell you what we didn't anticipate. We didn't anticipate that the cycling from high growth companies to the banks and the resources by the instos would have such a dramatic impact on prices of the companies that we own. Many of them have fallen 30%. Wow. But it's great because we couldn't find any value, we had 30% cash. So we've got a lot of cash to deploy now to buy the things that have fallen a lot. And the time to buy, obviously, is when everyone thinks the world's about to end. And these things have, you know, for example, Healthscope, you know, they had one month where they saw admissions more volatile than usual and a little bit softer than usual, and management came out and said, well, if this trend that we saw in September continues for another 9 months, we'll have flat EBITDA growth. And the stock fell 27%.
Wow.
You know, and so we thought, great, because we know the long-term trends for admissions are driven by 64 to 75-year-olds,
Yeah.
65 to 74-year-olds and plus 85-year-olds, which are the two strongest and fastest growing cohorts in the population.
Wow.
You know, the baby boomers were the first generation to take up jogging and aerobics. They're going to all have knee replacements and hip replacements.
Yeah.
So, you know, we know that these long-term trends are in place, but in the short run, it looks quite dire. But back to your question, we don't think about Trump, because in 4 years' time there'll be another election, and we are investing for well beyond the next 4 years. So we actually don't spend much time thinking about it to the extent that it offers an opportunity for us to do something.
Yeah, and I think you've got to try
done.
and recognise that. So if he comes in with a tax policy fiscally and it's all a bit of a dog's breakfast, then it'll have ramifications.
Well, stocks will rise in anticipation of growth, on the belief that there'll be rising profits. But if bond rates continue to rise, and I'm not saying that they will or they won't, I believe that irrespective of whether they stay lower for longer or go up, you're going to get low returns out of the stock market generally. But if they do start going up, then eventually the market will stop thinking about growth and start thinking about the present value of those cash flows, which is lower when interest rates go up, and the stock market will come off again.
Yeah, what's your sense, though, of the pressure in the market? The way you've just described that 30%, the REIT market, there's a whole range of different things that are being coming undone. And it's, you know, I look at it and go, this doesn't make sense. I write to it and say, can you please tell me what's actually happened? I mean,
well, I explained it. So there was a rotation out of these.
Yeah, I get all that, but that doesn't make it. That just means the herd is chasing. So that
correct, and that gives you the opportunity.
What pressure does that put on people like yourself and other organisations in terms of how your investors think? And the same question for you. You know, how does the
our inflows are going up? So our inflows have accelerated. We have spent the last 2 years asking investors to prepare for lower prices, and when they come, when our unit price for our fund drops, that will be the time to invest. Don't chase momentum, wait for a correction. We're seeing that now. We're seeing so many companies like Isentia and Altium and Vitagroup. Yeah, Vitagroup and Healthscope, you know, they're off 30% in 60 days. So this is the time to actually be putting some cash to work, and our investors are doing exactly that.
So you get lower yield now, as if you invested today.
So they're ending up taking a bond market return. Sorry, they're accepting a bond market return, but taking equity market risk.
Right.
And those two things don't coexist for very long either.
When it blew out at 3%. That was in February of this year.
Right.
So remember how
when we had the big correction.
Big correction, 3%.
Financials. Yeah.
That was the margin for error. That all sort of made sense. Now it averages about 2.5%. Between the dividend yield. Now remember, some don't pay many dividends. The ASX 200 doesn't have a great dividend.
But you shouldn't pay any attention to the average. I mean, you could...
No, but you've got to have benchmarks. So it doesn't really matter. It's like a referee. If he's wrong, as long as he's consistently wrong, I don't mind.
Yeah.
They're wrong the same way. And so that's how you look at these things. If what do they move?
The way I think about it is, if I stick my head in an oven and put my feet in the freezer, my average temperature's good, but I'm dead.
But you know that's not the way statistics work. You know that you've got to follow what are my benchmarks, because you could say here are the winners within it, and that's fine. People can pick winners. But if you're a passive index and you're following the passive curve, at the moment you're as tight as you would ever want to see.
Yeah, and it's interesting looking at that chart because you were mentioning, Charlie, how much debt has increased. What's interesting is that in the US, in the S&P 500 stocks, cash flow as measured by EBITDA peaked in 2010.
Yeah.
It's been declining since, even though debt's been going up. So what happens to cash flows when interest rates on that increased debt starts going up? And most of the debt, almost 80%, more than 80% of the debt, wasn't used for productive purposes.
No.
It's been used for mergers and acquisitions, special dividends and share buybacks.
And
so
the other
financial
thing
engineering.
about the S&P 500 and the cash since 2010 is that the majority of the cash has been in the top 90 companies.
Yeah.
The S&P 500, though, has got, I think it's something like 1.6 trillion in cash holdings.
Right.
Of that, half the bottom 250, they have 90 billion. it's the Apples, it's the Facebooks. They hold all the cash.
It's the same.
So you're seeing the cash go up, but it's concentrated. The rich are getting richer.
Well, it's the same thing in Australia, and just using exactly the same observation with Australian mortgage holders. So when you look at the RBA statistics, they come out with their chart pack, and you look at total household debt, it's at a historic high, but so is cash balances. And so I had people say to me, but Roger, when you net those two things out, it's not that bad. And my response is, yeah, but the people who've got the debt don't have the cash.
Yeah, I think they're trying to work out that link between the offset accounts and all that sort of stuff, and the debt versus the offset. We've got about 4 or 5 minutes before we go to the break. Can we bring up the next chart that Roger brought in around the income? Because I think income story is the story.
Yeah, exactly.
What's happened to it? So
okay,
how would we read this?
So I only want to focus, this is from the Reserve Bank of Australia, I only want to focus on the top section. And in this first chart, what you can see is since 2011 at the very top, that's the payout ratio for all listed companies in Australia. Obviously largely influenced by the top 20. But what you'll notice is that the payout ratio of the top the top companies in Australia has risen from about 57% since 2011 to over 80%. Now, the corollary is that there's less profit being retained for future growth. At precisely the time, and if we go to the next chart, so if you can just pull up the next chart, guys. We go to the next chart again by the RBA. What they've done here, which I think is fascinating, they've divided the stock market up into 3 sections and those 3 lines. The gold line is the PE ratio of stocks that are paying more than 75% of their earnings out as a dividend. The green line are those stocks that are paying 50 to 75, and the dark black, or the black line, is under 50%. And what you'll see is that at precisely the time companies are growing the least because they're paying out the most, they're the most expensive companies.
Yeah, right.
So people are paying the most for the companies with the least growth.
Yeah, I get that. Anyone who wants to try and get these charts, you can easily email me. It's mark.todd@nab.com.au, and I'll get the pack that the boys have put together today and send those packs out so you've got some sense of it, because it does help, particularly those who are in the podcast. So if you want to do that, just email me. We wrote a white paper on our blog on that exact subject. Okay.
I've written a sort of 8-page white paper on it.
You can all do that.
Look, I have a question for Roger. I think you guys were talking earlier saying that you'd seen quite a significant steepening of the bond curve.
Yep.
And we've seen banks rally significantly as a result. But is that not perverse, given that that means we're going to have increasing rates over time, and bad and doubtful debts should increase as we go forward?
Sure.
Yeah, so what we've had is, it is a perverse outcome. And it's a function of what I said earlier. It's a function of very large institutional fund managers that were caught underweight, believing that there will now be growth. We don't hold that view. We think that credit growth will be challenging for the banks going forward, partly because, or mostly because, we've already got record high credit card debt, we've already got record high mortgage debt, and we think that ultimately the oversupply of apartments will lead to an end to the construction boom in residential development. And so credit growth for the banks will be under pressure. At the same time that credit growth is under pressure, we think net interest margins are under pressure, and we also believe that the requirement for more capital is going to lower permanently their return on equity for some time. So in the short term at least, and when I say short term I'm thinking 3 to 4 years, I don't think that the banks should be rallying as hard as they have.
Okay, the other side of this would be the following. The banks are aware of the bad and doubtful debt scenario, and what they've done is they've been pulling back. And I think on NAB's last announcement on their full year, they were making the point that there was a lot of customers that they hadn't lent to because they chose that they wouldn't pay the price. So what they're doing is they're charging people more money. So that was to Charlie's point about how the cost of credit is going up, and they're saying to the clients, okay, you need to pay more money. It also means that on
demand.
Well, sure, but they're making more money on it as a percentage, and it's whether people can make the payment.
Yeah.
So you're living on 4% and you're now going to pay 4.5%. So they go, oh, well, I can probably pay that. And so the other point was that in the mortgage books, as they ratchet them up a little bit, Westpac did it today, it has a huge flow-on effect into their profitability, because a vast percentage, mortgage values would be at 1%. That's the sort of stuff. So in the property market, in terms of the apartments, they have really been pulling back. So we're seeing a lot of people saying, I need to get money from the shadow economy, I need to get money from other lenders.
Well, the developers are all getting money from mezzanine.
Correct.
Yeah.
And so it's a question of, have the banks been managing their books? The market seems to be thinking they're doing it, and the last announcements have been that they've been paying their dividends. Now, I'm not saying they are. I'm just saying
what I think, though, is that the banks are pulling back from lending to developers, but the developers are getting the money to go ahead and produce anyway.
To an extent, absolutely, but there's definitely also the wind back. There's definitely... the market's hot. The market is still hot in the property market because people are trying to find where to put money. And volatile assets are really troublesome.
And
what's the rate at which the US economy can grow? It's probably 1%.
Look, let me tell you what we know. Let me tell you what we actually know. For the 20 years between 1964 and 1960 and 1980, interest rates rose dramatically. In that time, the S&P 500 returned 3.6% per annum. Okay, low returns at rising interest rates. Between 1980 and 2000, you had dramatic falls in interest rates and the equity market risk premium combined, so your discount rates all came down. And during that time, the S&P returned 14.7%. So it doubled every 5 years. So it was a great time to invest. But since 2000, you've had interest rates declining, but the equity market risk premium has gone up, so your discount rate has been flat. And guess what the return has been for the S&P 500? 2.5% per annum.
Yeah.
So it doesn't really matter whether rates rise dramatically or they stay where they are for a long period of time. For equity market investors who are just blindly buying the index, you're going to get low returns. Yeah. You need growth. You need to invest in companies that are going to grow.
So we have another chart, and that's about the growth story. So I wanted... this is not an equity show, don't get me wrong. This is an income show. This is about, Charlie will protect some of the money. It's about how you construct a portfolio. I don't know about you, but I own equities. I own bonds, I own equities. I have what I think is a balanced portfolio. And the growth piece is a piece that's lost. It's just not happening. It drives me nuts. Equity guys think it's all growth, and they're kidding me.
Telstra's profit hasn't grown for 7 years, 10 years or 15 years.
This is this is a chart.
So the reason why the cross and the two ticks are at the top is because we own CSL and we have owned M2 Telecommunications. We've never owned Telstra. Go back to 2005, which is the first part of this table, and what you'll see is that Telstra was offering a yield of 5.97%, which was higher than the other two. Now, the problem was that under Sol Trujillo in 2005, Telstra was paying 100% of its earnings out as a dividend. All right. M2 was retaining a proportion of its profits and compounding it, and CSL was doing the same. And both of them were compounding at very high rates of return on equity. But so Telstra had a high rate of return on equity, but it was all being paid out. What's the impact of choosing Telstra and not choosing the other two? Well, if you put $100,000 into Telstra back in 2005, by 2015, December the 31st, so precisely 10 years later, that $100,000 grew to $117,000. So it barely kept up with inflation. That's your capital. But your income grew from only $5,970 to $6,500. It didn't keep up with inflation. What could be riskier than being guaranteed to have less purchasing power in the future than you've got today?
Yeah.
That's Telstra. Contrast that with M2, because we haven't got time to go through all of them, but contrast that with M2. $100,000 into M2 grew to $3 million 10 years later, so you have a 30-fold increase in the capital, but more importantly, your $3,910 of dividends in 2005 grew to $99,800 a year by 2015. You had a 100% dividend yield 10 years later. You have to go for growth. You have to buy businesses that are retaining capital, retaining profits, and compounding it at a high rate. And given that all of those stocks have fallen so much now, and everyone is still locked into the Telstra, the banks mindset, now is the time to be rotating. Take profits on Telstra, take profits on low growth, mediocre companies, and put it in high growth.
Quick email from Graham, and Graham said, is the market a buy at the moment? Analysts write about the 2 to 4 year horizon, yet market volatility drives very short-term response. How should investors look at 2 to 4 year predictions? Now, I am mindful of the fact that you said you've got to invest for the long term. I don't think that's the question. How do they look at the predictions of 2 to 4 years? Do they discount them? I know that that people are saying that in the next 2 to 4 years the banks will lose customers, or whatever they're going to say. How do you look at the longer term?
Well, we don't use consensus analyst numbers anyway. We don't really pay much attention to the buy, sell or hold recommendations.
Oh, okay.
And we build our own models. So we have a software program called SALT, which stands for Security Analysis for the Long Term, and it is a more accurate predictor of earnings 2 years out than consensus analyst estimates.
Right.
So we don't pay a lot of heed to it. I think irrespective of your age, you should always behave in the stock market the same way. And that means that volatility is delivered in the short term, and that should be seen as an opportunity for sensible long-term investing.
Another caller, we have Conrad on the line from Orange. Hi Conrad, how are you?
Good evening. How are you?
Oh, Conrad, you're not well.
I've been better. Question for the panel. There seems to be, over the last year, a fairly concerted attack on the cash economy by Canberra in terms of regulatory changes.
Yep.
Could the panel comment on that?
Sure, no problem. The sense that the government... So, let me rephrase this. The cry from all the central banks across the globe has been we need a fiscal response because you are running out of money and we're doing all the heavy lifting. Is Malcolm listening? Is that what is happening?
Well, what you've seen in some countries is they're getting rid of high denomination notes.
Just seen it in India.
Yep.
Yeah. So
Yep.
I think it's absolutely right. I think it's fair. I think it's unfair that I turn up to a cafe and I am buying, and they tell me cash only, in 2016. When the technology is there are no merchant charges for transactions under $15, and yet they charge you more for a transaction under $15 or tell you have to spend more. It's just bizarre. They're not paying their tax. That's why they want the cash. I've seen it when I was down in Melbourne. I was at a cake shop because I had to buy a cake for my mother, and they just had the till open. And I walked in. I said I'd like one of those cakes, and they said that'll be $57 or whatever it was for the cake. They said cash only, so I gave them the cash. She puts it in the till, no receipt. So I said I'd like a tax receipt, please. Because then she had to put it through the register and type it up.
$60.
She was just going to hand me.
I think this first started. There's a few things here. The 500 euro note was just the currency of choice for international criminal syndicates, but also there's a huge number of $100 bills out in the US. An enormous number. And again, it's trying to just drag in this black economy and
correct.
And firstly be able to account for it, make sure it is paying tax. I think the technology is there that we don't really need those high denominations,
no.
But everybody likes
we
to
actually don't need cash.
Have some in the sock drawer just in case the power goes out or whatever. But I'm kind of in a
So, Conrad, the Moody's will come out and make a decision on whether they think Australia should get downgraded. I will set aside for 1 minute whether I think that's good, bad or indifferent, or whether it will impact on markets. But there is a lot of pressure in the system to say that your fiscal story is not accurate. You need to get more money. Now, are the inputs assuming coal at $300? Definitely not.
No.
So are the inputs right? That's always been my question. What's the modelling? And I'm not confident that the modelling's right. So I am sympathetic to those who say, I don't want to pay the tax because you're hopeless. But I can't tell you how many times I listen 3 months after Treasury's come out and they go, hang on, the deficit's actually going to be this. And they're going to give me through the medium-term cycle and then the forward cycle, this is what the debt load will be.
Can I just make an observation? It doesn't matter whether you think the government's doing a good job or not with the money. The law is you pay tax.
I'm not saying don't do that. I'm saying the complaints you have should be based on the modelling and then make a decision, have you got the right politician running the system. That's all I'm saying. I'm not saying don't pay your money. Everyone has to pay the tax.
There's a bigger issue that's, I think, bigger than the black economy in Australia, and that is that it currently requires us to export 7 tonnes of iron ore to pay for 1 iPhone imported.
Sure.
Our balance of payments current account deficit could be improved dramatically if we added value to our exports, but we don't. And the reason why we don't is because we don't have any industries that add sufficient value, and so what we need to do is we need a tax holiday for startups to let the market work out what we're good at and what we can add value to.
Atlassian or whatever you call it. Okay, so commodities are up, currency's down, non-mining, we've got to the non-mining. I mean, the services sector is doing well, banks are doing well. The miners are now doing well. Where are the headwinds? Because if Moody's say, listen, we won't have enough tax, well, hang on, everyone's doing pretty well.
Look, the headwinds, I think personally, we've written a lot about the RBA cycle and been lucky
He'll
enough
have a blog as well.
to call, the cuts in 2015 and 2016. We think the RBA are on hold for an extended period now. Clearly, terms of trade has improved as a result of commodities finding their feet a little bit. But we still...
A little bit.
Well, by a lot, let's be honest.
Let's be honest, guys.
Yeah.
Listen, I can bring a chart next week. The coal price went from $75 to $300 last I looked. And iron ore, I mean, these things
I don't think those prices are sustainable.
They're completely not sustainable, but they are there. And do you think it's easy to get coal? What's the delivery? Just
remember, the last time coal was strong and iron ore was strong, it took 7 years for the development pipeline to catch up and for there to be an oversupply situation.
Yeah.
This time around, it's press a button. It'll take months, not years.
This doesn't create employment, and we've seen the employment data over the year. We continue to lose full-time jobs. Now, we're gaining part-time jobs, so the headline numbers aren't that sensational. But if you look underneath the hood, we are losing full-time
Rio
employment.
dropped people last week.
Right, and so as these commodity prices come back, we're not pushing people back out into Western Australia and up into Queensland to get to work. This is vastly, largely automated. Now think about Gorgon. 97,000 people to build it, 3,000 people to operate it. The whole thing's automated.
You go to Germany, to the mining expo there.
You don't go to Germany. And it's there. It's in Queensland.
But they're selling these things that look like Transformers, like that, that American movie. There's no cabin.
It's all automated. Where they drive the truck from?